Hello and good afternoon. I'm Sam Thompson, Senior Managing Director at Progress Partners, and I'm happy to welcome you all to this week's panel, Corporate Development, Tales from the Buy Side. This is the fourth panel of our second Progress Connect webinar series titled Business Growth Hacking. This week's panel brings together some thought leaders from corporate development to discuss the strategic buyer perspective as we enter the second half of 2020. What have we seen so far this year? How remote work has impacted day to day and where we go from here. I'll step back momentarily so my colleague, Chris Carl, Progress Partners Managing Director and moderator for this week's panel, can introduce our panelists and set the table for today's panel. That said, let me quickly run through some housekeeping items before we get started. First and foremost, as you form any questions for our panelists, please keep in mind we have several public companies represented on this week's panel. This discussion is not for publication, and these panelists are not here to talk about quarterly performance or any other non-public statements. Without further ado, I will hand things off to Chris Carl to get things started. Thank you.
All right. Hi, everybody. Thank you for joining us today. First, I'd like to thank my panelists and introduce them for jumping on with us this afternoon.
I'm Sean Alford, Senior Vice President, Corporate Development at J2 Global. J2, for those who are not familiar with us, is a publicly traded, diversified internet and information services company. We own a pretty broad set of brands and businesses across cloud software and digital media, really organized into a couple different themes or buckets. We've got on the cloud software side, communications, security, marketing technology, cloud backup, and consumer privacy. On the digital media side, tech publishing assets like Mashable and PC Mag. We own gaming and entertainment businesses like IGN and Humble Bundle. And then we have a collection of brands and businesses under the Everyday Health Group umbrella focused on healthcare.
Hi, I'm Gil Fuchsberg, and I'm Head of Corporate Development and Strategic Planning at Roku. Roku is the leading streaming platform in the United States, growing quickly in other markets. About 40 million, over 40 million households spend around 4 hours a day watching streaming content on a Roku device. We reach consumers both through set-top boxes and sticks that we manufacture under the Roku brand, and then a set of over 15 TV manufacturers who make Roku TVs, which embed our operating system and enable users to have their streaming experience be at the same level as their linear TV experience. We work with every major video IP owner and publisher. All the major streaming services are on our platform, and we have grown the business over the last handful of years to be much more focused on our Roku platform as opposed to hardware. 90+% of our gross margin and all of our profit comes from our advertising and content businesses, and those have been growing fast. And we publicly reported that we, have certainly seen an increase in consumption and streaming activity as a result of the pandemic, and we're pleased to participate in this panel.
Nice, thanks. Eric?
Hi, I'm Eric Kovanik. I'm the Chief Strategy Officer of Rubicon Project. Rubicon Project is a public, independent sell-side advertising platform. So we work with premium publishers to help drive programmatic advertising for them. So essentially running the pipes and the guts of the exchanges that are out there that connect buyers and sellers in this, programmatic ecosystem. We don't really do anything consumer-facing, so most consumer folks wouldn't know us, but we've been around for a while now in the programmatic space. So I think most ad networks and most people who sell programmatically their digital and now their CTV type inventory would know us. We recently completed a merger with a company called Telaria, which was a similar business, a sell-side platform focused almost exclusively in the connected television space. And so the combination of the two makes us the leading global independent sell-side advertising platform. Now, there are some non-independent sell-side advertising platforms like Google that you've probably heard of, who we do partner with as well as, coexist with and compete with and work very closely with in many regards. That's my introduction. Happy to be here.
Awesome. Ryan?
Great. Hi, I'm Ryan Kleinfelter. First of all, thanks, Chris and Progress Partners for hosting me on the panel. Really, for the last 10 years, I've been in corporate development over digital media, ad tech, mobile technology, and most recently here at Vungle, running the corporate development efforts. That's it's like jungle, but with a V, for those that aren't familiar. Vungle is really monetization for apps. So if you think about it from a high level, but I think we're more than that. We're becoming more than that. We're really a trusted guide for the growth and engagement. So transforming how people discover and experience mobile apps. So for developers that partner with us, it's about them monetizing their apps through these innovative ad creative experiences. For advertisers, it's really depends. They depend on Vungle for reach and to acquire and retain high value users worldwide. We're headquartered in San Francisco. We're still a private company. We have 7 offices, about 275 employees, more or less. And in 2019, we were bought by a large private equity investor. So together, together, we're really kind of looking for a growth story to continue through organic and inorganic activities at Vungle.
Awesome. I'm excited to have you guys and get your perspective on a few things. To kick it off, if we can go to the following slide, we have a perspective on the market a little bit over a longer term. And if you think about the economic climate we're in today, it seems as though, and we've heard we're in a recession officially, it feels to us, just from our point of view, what we're seeing here at Progress, if you look at the past recessions that maybe are more cyclical in nature, where the market was due to correct itself, this COVID recession is something that's brought on, at a time when the economy was fairly strong. So what we're thinking as we come out of this and things open up, we believe that based on the fact that there's ample amounts of capital within the PE part of the world, the fact that interest rates are still and remain low for the foreseeable future, there will be a robust volume of M&A going into the next year. And, like as opposed to what you see in some of these recession slides where you've got volume going down and value in M&A deals going down. So in the next slide, we look at more specifically the breakdown between financial and strategic buyers. Today, we've got a great group of strategic companies that are marching forward on their growth plans. It's interesting to look at the balance between the strategic buyers and the financial buyers and the EBITDA values. It's pretty steady. There's been an increase slightly over the last 8 years or so in EBITDA multiples. But the way M&A has come about and almost standardized and institutionalized itself, there's a natural progression of companies once they get funded to continue to build, and there's ample amounts of capital out there to continue to fund these companies. And M&A is almost an end game or part of the strategy for many of these investors as they get into these companies. So that's just a little bit of some numbers. If you think about that in the context of your own businesses, and geez, before we dive into that detail, I'm thinking, having had conversations with you independently over the last couple of years, this 3-month period we've been through has dramatically changed a lot for a lot of us. And I'm wondering what it's like to do corp dev in a climate where we're all in lockdown. I mean, how do you, in your offices, I got to believe that you've got people leaning over your shoulder all the time and, asking questions. And so what's it been like? Sean, maybe you can chime in on what it's been like the last 3 months, doing a lot of Zoom calls, I imagine. But it's hard to poke and prod people over a video call.
I'm never a poker or a prodder.
All right.
But it's been very different. I mean, you and Sam know RMO at J2. We're high velocity, high volume M&A. And a lot of what we do is in the lower middle market where the in-person connections are very important because you don't get the benefit of public financials. In some cases, you don't get the benefit of full audits. So the in-person high touch of our M&A program has certainly been impacted by this and has changed the way that we have to do business on the M&A front. You know, I think in deal cycles, would love to get the perspective from the other panelists, but you kind of see the full life cycle of a deal typically take a minimum of 3 months, and it's kind of a 3 to 6 month dance. Some of these take years. We've been in situations where we've been able to do it in weeks, but it certainly takes a runway to get a deal done. I don't think we've seen the full impact of what this pandemic will do on deal making, because 3 months in the context of things is really not that long of a time period. So it's been interesting to read the headlines that deals are getting done. I think those are the long tail of things that have been in process for a very long time. And we've been spending most of our time on those conversations that predate the pandemic, because that's where we've had the in-person conversation. We've broken bread. We know the business in a way that you just can't know a business in this environment. You know, I'd say my role and our group has really had an opportunity to shift our focus internally, which has been helpful. And I think what we've found is really comforting at J2. Now is the time when scale matters. We've got that. Now is the time when diversification matters. We've got that. So while there are pockets of our business that are challenged in this environment, there are also pockets of our business that are thriving in a work from home environment.
Interesting. Eric, any thoughts on that?
Yeah, well, you know, I think, Sean, you said it best. There's a life cycle here. And so I don't have anything to add about the top of the funnel, but we closed a merger and did a bunch of the integration during the pandemic, which was sort of the bottom of the funnel. And definitely helpful that we'd spent the 6 months prior getting to know each other. And we'd already done, as you pointed out, the breaking of bread and got to know each other and had really actually made a lot of progress in the planning stages on what that integration would look like and how we should do it. And, you know, we were fortunate that our deal was far enough along. Proxies had already gone out by the time the stay-at-home orders were issued. So we could get through the close, but then we had to get through the, you know, the joint celebration, which you couldn't do in person, and move into some of the more challenging, you know, human-based components of integration, which is, okay, who's going to report where, reporting to whom, focused on what, and how do you divvy up a bunch of those areas where, you know, once you really get into the nitty-gritty, you're only going to have one person who handles this account or who leads this area. And we had to make a bunch of those decisions, and doing that by Zoom in some ways was more efficient. It's going to sound a little bit crazy, but normally a lot of things that your instinct, and it would be 100% correct to say, well, we're going to do this in person. We're going to get on a plane. We're going to fly here. We're going to get everybody together. We're going to then decide in a really kind of nuanced way where you're really taking care of everybody and really, you know, soft hands on all the people, which I think is absolutely critical. During the pandemic, in some cases, you just didn't have the luxury, right? We had to go out and pick people to lead in different countries. And there's just no way you're going to get together. So you just kind of have to make calls. Right. And the pandemic sort of, in some ways, it forced your hand to say, you know, we don't know if this is the right call or the wrong call, but we got to make a call. So we're going to make a call. Right. It was interesting. And I think in many ways, in that kind of a situation, you won't really know how you did until sometime later. I mean, that's always the case, but you won't know till later when you get back in and, you know, in doing it this way versus that way, did we make the wrong call and piss some people off who are thinking about, you know, they're unhappy, or did we do it the right way? If we did it the right way, we'll take credit for it, even if it might have been, you know, lucky rather than smart. So we'll see, but it was certainly an experience we'll never forget, for sure.
Did you guys, Ryan, maybe, or Gil, would love to hear it from you. Have you seen an increase in the volume of just activity, general activity? Are you guys getting tons and tons of inbound, or are people waiting to see what happens? There's kind of two schools of thought.
Yeah, I think the answer is yes. There's been more over the transom inbound than there had been previously. There's also an unusual amount of urgent. We must, have a discussion around this immediately, which almost always turns out not to be the case. And I think the degree of expectation around process has not really changed all that much, even though I think, to Sean's point, it's really tough to get to know a management team really well via a set of short Zoom calls. I mean, there's no substitute for the, full day and a dinner and the next day with team, where you have a chance to really understand the full picture of a business, as opposed to little puzzle pieces which you might be able to grasp in the context of a Zoom call.
Yeah. You've got an inbound coming right now. A phone is ringing off the hook.
Sorry about that.
No worries. Ryan, any thoughts?
Yeah, I mean, one thing that sticks out a little bit, which we thought was going to happen, but we haven't seen so much of, is more of a distressed deal profile come our way. We had a thesis where, folks would be running out of money or being short on cash, and we see a lot more distressed type of companies. And for whatever reason, we don't know exactly why, we didn't, source a lot of those deals. But we've actually been, fairly happy with the number of deals coming our way. I would say we've seen more deals in the last 30 days on a trailing basis than the last 120 days. So I think at the beginning, when people were, focused internally, it was harder. As you guys already mentioned, some of the top of funnel was working its way through, and we were really harvesting the relationships. But I think now, after, for whatever reason, again, things are opening up slightly. We're seeing a little bit more deal activity, a lot more inbound, some from Progress Partners as well, of course. Some from other banks, and some proprietary deals. So we've been pretty happy, I would say, the last 30 days. We were getting back to probably more or less a normal deal type of activity.
Yeah. I gotta say, it's fascinating to hear Gil and Ryan say that they've seen activity pick up, because we effectively saw bank-led processes fall off a cliff in March. We, at any given point in time, we're looking at somewhere between 75 and 100 deals. And that in March and April was down to 25 to 50. I mean, just precipitous drop off, and banks saying, hey, our client just pulled the deal. They said they cannot sell in this environment. We've started to see some return, but we're not back to where we were. My hope is that we'll get there, but from our seat, I think the banks have really been told by their clients to just slow down. You can't sell right now. And on the distress side, to Ryan's point, it's an area where we've got some experience. It's not all we do, but we do have experience with turnarounds. And what we've found is that in this environment, what the Fed has done has really worked. People that maybe should be in distress aren't in distress in any capital, because of the cash that's been made available to them by our government. So, I think this is just an example of how hard it is to put all the pieces together to understand what's really going on, because on this call, we've got divergent perspectives on, what's going on.
Yeah. Well, what's interesting about the cash is it was a temporary gap. And the question is, are we headed into really uncertain times if the cash doesn't keep coming for certain sectors of the market? Do any of you have any thoughts about, the changes? What are you looking ahead? What's changed permanently? Because I think collectively, everyone's realized that we're not going to go back to the way things were completely. There's a new set of norms for everything. In your businesses, what do you feel like has changed permanently? And one example that came to mind for me in media is the upfront process. Are there any changes in that? Like, Roku, I know Gil announced you've got a new front event, I think in the next week or two. Is that process virtual now, and it just everybody participates virtually in it?
Yes. I mean, we're kicking off the new fronts early next week. And my understanding is the demand in terms of registrants, way exceeds the volume of people who would have attended that event in normal times. So we consider ourselves, to be in a fortunate position in that regard. I have no idea who's going to show up, but I think the benefit of the virtual proposition is, at a minimum, it allows a lot more people to be exposed to it, just by dint of people who would never have made it to that event in person.
Yeah, it expands the audience quite a bit. That's
Totally.
And that's a big event. I mean, that's a several thousand people event.
Yes.
So it should be huge. Any other changes, permanent changes that you guys envision in the market?
I certainly think there will be changes to how business is done in general around remote work and what employees you need in offices. And even if you have some small percentage of your people who end up becoming sort of permanent remote workers, does that mean you really have to change your culture around how you do meetings and how you use video and how you think about time zones? And so I think actually personally a lot of that is for the good. Where I think it gets a lot more interesting is to say what happens from an M&A perspective, what happens from a sales perspective. I mean, at some point you got to go break bread, right? You got to go meet them, and as this has already been stated, you need to do that. And certainly if you're down the path on an M&A process, every single one of us would go do that, right? The question is, maybe a little bit earlier in the funnel, do you say, gosh, this is still exploratory, maybe we just do this by Zoom meeting versus meeting in person, or hosting somebody, or hosting them and then taking them out to dinner. So I think those are the areas where, until you get widespread public confidence about the pandemic being over or under control or a vaccine out there, right? It feels like that's where you're going to see some slowdown.
Ryan, any thoughts?
Yeah, I mean, a little bit on the tactical side, I think the diligence process will definitely be more sticky on Zoom going forward. I think we found that law firms for the first time are jumping on Zoom meetings, and others that haven't maybe used some of those technologies. So I think the way deals are getting done will be changed forever, and maybe for the best. And then maybe another prediction, though we're sensing it, that the deal teams become a little bit smaller just because of how nimble you have to be, operating these Zoom calls and doing diligence remotely. So you can't have 40 people together. You literally just can't talk at the same time like you would if you were around a round table. So, the size of deal teams may be smaller and then more nimble, generally speaking. And then we'll see if more technology is actually introduced into the process, which I'm hoping for. On our side, using Slack for the first time on deals with the targets was something kind of new, seemed to be helpful. So a few trends there that hopefully stick post-COVID.
Chris, I think one of the big questions is whether or not a deal that starts remotely, in the pandemic, gets to closure without the quality of in-person engagement that typically characterizes these deals. There have been some stories in recent days around VCs that have been closing deal after deal, even in this context, in some cases saying, oh, well, I broadened my geographic exposure. I think that might work for a follow-on financing or as a follow-on investor to a lead who's done the diligence and knows the team. I just can't imagine a lot of buyers closing a deal without having spent a material amount of time with the management team of a target. Hard to imagine. Maybe that's a question for the panel.
We're going to find out. It sounds like, based on what Eric said, he wants to break bread with people. Sean, you guys are high volume. Can you envision doing a deal without meeting the management team?
We have before, and we will again.
Mm-hmm.
Risk tolerance changes with the size of the deal.
Right.
So as As we look at larger deals, I think that in-person component is more important. As we look at smaller deals, less important. As we look at sectors that we know very well, where there may be pre-existing relationships, less important. New sectors, which we do, new platforms, I think it would be very hard for us to do a deal without being in person.
Right. So when it comes to the deals, this is always I love that I get to that. This might be my favorite question. When it comes to the deals, give me some sense. I mean, we know, the team factors into it. Obviously, profitability, the fact that the company's making money usually helps. Engineering prowess, like some of those things. Like, what are some of the components that drive deals for you guys? What gets you excited when you look at our, our briefs and when we send you guys? What are the keywords? If I had to think about it from a keyword perspective, what are the words? Does anybody care to share?
I can say our perspective is so diverse.
Mm-hmm.
It's going to vary. I mean, when we're going through the screening process for inbounds, the first question we have is, where does this fit? So is this, I guess, number one, is this a platform acquisition or a tuck-in? Most of what we look at falls into the tuck-in category. So then it's, where does it fit? And that's really understanding the narrative that you guys or others put together that explains what this business does, and then thinking creatively about how we could attach that to something we own or unlock value with something that we own. Because you hit it at the top of the call. Having a lot of cash is not novel. There's a lot of cash out there. So to get a deal done, you've got to have some other angle. So we really go to that strategic element first and foremost. Then J2 is a permanent capital vehicle. So we are probably more focused on the long-term, sustainable, profitable growth than a growth investor might be. We want to figure out what that terminal velocity is, because every business has one. When will this business hit it? And what does that look like over the long term?
Yep. Eric, you have any thoughts?
We're trying to be very, very strategic in what we do. And as we bought a company last fall that actually was introduced to us by Progress Partners, and just loved how it was just a spot on strategic fit. And I think, but it in that case, certainly it came down to the founders and the leadership and the fit, because with a I hate to call it a tuck-in, but basically it's of that size, that's a smaller transaction. You're kind of going, okay, we got to work with these guys. How do they fit?
Right.
And what are they like as people? And that's what gets, back to the prior point, right? That's really hard to do and assess over Zoom. Like you got to that point over multiple rounds of, meetings and dinners and talking to people and just seeing how they behave and going, okay, if this person now is leading something really important in our company, will they fit? Can they do it? Can they drive it?
Mm-hmm.
So.
Okay. Ryan, on that front, what as you look to grow your business, do you have a particular mandate or definition you're trying to fill in terms of the qualities of the types of companies you're trying to? Is profitability the key? Does a firm, a PE firm, when they look to add in, is profitability the key thing?
Yeah, well, I wouldn't speak for them per se, right? They definitely have their own very formed viewpoints, but I think as a collective unit, our company, we're always trying to fit the accretiveness of financials, the boring basics with the accretiveness of the strategy, and where that intersects is really where we want to do deals. We're also maybe a little bit like Eric in the ad tech space. There's a lot of companies out there. So for us, there's a lot of no's, and really understanding why we're saying no helps inform our future filters. So as we go through that process, we're relatively new to grow our company with M&A, so we're refining those filters all the time. But for us, the process of saying no and understanding why is really kind of informing us a lot. I mean, of course, we're looking for high growth companies, high margins, all the rest. But we also have a pretty ambitious strategy that we're trying to embark on as well. But Yeah, it's a combination of what everyone else has said, but then also, looking at this very crowded ad tech, mobile tech ecosystem and making sure we're not missing anything and we're saying no at the right times.
So when my takeaway is when dealing with in a process, if you're courting a strategic buyer, understanding their business, which is kind of good lesson in sales at anything, understanding the buyer's business and identifying an easy point of connection with that business that appeals to them strategically is the way to approach it. Any advice for CEOs that are out there that we may be on the listening here that pertaining to how they operate their business in this climate? Do you reward conservative behavior or reward risk? Because right now you could argue that you could argue either way. Like it's time to be aggressive or maybe not to be aggressive, especially when you think about a younger company, and you've seen lots of P&Ls when you look at the cost of office space around the world and T&E on going to conferences in Cannes and to Mexico and all these places. If you strip that out, companies have a different profile. So like, should CEOs be thinking about becoming more virtual? Is that, Sean, what do you think?
Yeah, you're raising a great point, which goes to one of our core questions for any target now, which is how have you responded to this? It can be very telling. On the one hand, a crisis is a terrible thing to waste. And I think we like seeing the CEOs who have recognized that and have seen this as an opportunity to correct course that they were having trouble correcting before. One of the things that we've spread across our portfolio is this Sequoia letter that came out earlier in the year, this Black Swan letter. And one of the key points there that we've heard before is that revenue and cash come down much faster than expenses. So the people who can manage their expenses with speed, I think, are the management teams that we find ourselves gravitating toward.
I do think, given how much uncertainty there is, preserving, maximizing, optimizing for flexibility, runway, and capital, I think is really an important trait. If you grow your way, to bankruptcy, that's not a sustainable proposition. And I think for any kind of company that's in a growth phase, there's a very direct trade-off typically it's a very direct trade-off between growth and cash consumption. So I think those who are able to calibrate to sustain and grow more modestly, but know that they're going to be around in a year, I think that should be a key consideration for any business at this point. And I think raising capital in this environment is obviously happening. And there's still unicorns raising money. I think it's going to be harder if you're not a super high profile or with a differentiated business model and a mastery of this balance between growth and cash consumption.
It's a balance and a challenge, I gotta believe, keeping a lot of people up at night. When you think about sectors in the back half, would you say there have been some obvious sectors that have been impacted by all of this, like travel has been impacted. Do you see any sectors that you think will come back strong? Do you see any sectors that go away? Like any bold predictions on things for the back half that we should think about?
No one wants to be bold, Chris.
Nobody wants to be bold.
If you would ask for predictions in March, we would have all been wrong.
Yeah, you would have had them. We'll cut this part out of the recording and no one will remember what anyone says.
Look, I think we are optimists generally. We believe in the sustainability of everything within the J2 portfolio. If we didn't, it wouldn't be a part of the J2 portfolio. So we think that we will be fine. The sectors where we're focused, I don't know that they differ much now versus where we focused before. We like asset-light businesses with recurring revenue models, with strong management teams who are focused on free cash flow.
Yep. A lot of these businesses are supported by the advertising economy, in parts of it, not your entire business, but it's a big deal when we look at the gyrations of ad spending. And specifically with the way things are getting more automated in ad spending, we saw how it really kind of goes down quickly, and it should come back quickly. In terms of the ad economy, I guess that's the leading indicator, and because it's real time, you get a pulse on that. Eric, do you have any thoughts on?
Yeah, I think it depends a lot where you play, right? So there are some product types that are going to be slower to come back. If you were in the digital out of home business, if you sold advertising on elevators, right, those little screens in elevators, that's probably going to be a slower ramp up. But at least from where we sit, our core thesis as a company is all about, being an omnichannel exchange. So we're everywhere, and really the bet is on programmatic advertising. And we feel like we're sort of swimming with the current on that one. And certainly the pandemic will move certain sectors up, certain sectors down, right? Some advertising categories will do better or worse in any economy, and that's going to always fluctuate. But the overall thesis, we asked ourselves when this started, does this change our core thesis about who we are and what we do? And I don't think it does. It absolutely will change specifics. And if you were the account manager in charge of airlines at any company that sells advertising, you're probably having a very different experience than if you're in charge of selling services to companies like Zoom and Google Meet. So those vary, but it's as I think Sean pointed out, it's like come back to your own core beliefs about yourself and your company, and that's really what you have to come back to. And I think it's healthy to periodically check on that, and certainly the pandemic is cause to do that, not just for your company, but for your life probably, right? There's a lot of things you ask yourself, hey, do I really believe in this? But yeah, so that'd be how I'd address your question.
Ryan, anything to add on that one?
Yeah, kind of putting a little bit of those thoughts together. I had a prediction. It's maybe boring, could be bold. We'll see. Sometimes they're the same thing. But I think there's one topic in all of our industries that really gone to sleep during all this, and that's the regulation, the privacy, compliance. That was all the rage last year, and obviously Facebook and Google were staring that down pretty heavily. We were watching it like a soap opera unfold. I think it's, for whatever reason, it's kind of slumbering beneath the surface. And I have a prediction that, RegTech, so regulation, technology, tech, venture investments, and then maybe followed by a wave of M&A will happen this year to kind of combat or bolster or address some of those. And that just depends on how quick Apple and Google are going to come back with their identifiers and the rest. But that could be a really big, kind of make a big splash again in 2020. So yeah, we're kind of calling that RegTech and putting a box around that and seeing if that's something that we should, look at, or if that's really, a prediction the whole industry can kind of get behind.
I would agree with that. I would agree. I've heard several companies in that space. Rights, like privacy, rights management, all of those things that are impacting. Sean, any thoughts?
Yeah, we're big believers that consumers have a desire for privacy. Haven't focused as much on RegTech, although perhaps we should. We've been more focused on consumer VPNs and things like identity theft protection. We believe that will continue to be a strong category, and hope that there are some tailwinds there in the back half of this year and beyond. I'm curious, Ryan, how do you define RegTech? You gave a brief description, but I'd love to hear more about that.
Yeah, I think Chris was, talking about the rights management and talking about those that will make, companies be GDPR compliant or do some analysis on that, or third parties that are looking at this in an automated way. Companies that have a business model that sits behind it, some of the CCPA requirements, and you could think of them like a DMP of sorts, and layering that on, a media buy, making sure the audiences that are opted in, opted out. So different ways to address regulation that seems to be kind of sweeping over some of the ecosystem. And some very small companies, right? So I can't even think of one large scaled one, but we're seeing some investment and hearing a lot of chatter in that. Maybe it's even kind of an almost 5 to 10 kind of horse race at this point.
And are the customers there only enterprises? Does RegTech apply to SMBs or consumers?
No, it would be like companies like ourselves in the programmatic and or sort of ad monetization space, people that are dealing with different kind of advertising models, principally. I mean, I guess it could go all the way to consumer level. We haven't focused on that.
So I've got a couple questions that I want to get to here from our panel viewers that have been so kind to join us. I guess since we're on the topic of COVID and disruption, this question pertains to diversity, which it looks like is obviously diversity is a topic that's coming on the heels of the pandemic. How does that play into valuations is the question. When you look at companies, their approach to diversity, it would have to, I would think, especially as a public company.
This is an important topic for J2, the topic of social injustice and the things that have come to the forefront. It's something that we are addressing portfolio-wide, firm-wide, and we're addressing it through specific actions. We've at Humble Bundle created a fund that is focused on Black game developers. We've changed some of our hiring policies and incentive plans to try to make sure that we're attracting and retaining Black talent. This has struck a chord across the senior team at J2. How it plays into our M&A philosophy remains to be seen, but it's something we have to think about, and that we will think about, and we will incorporate into the way that we evaluate companies.
Anybody else have, Eric, you're nodding, anything to add to that one?
No, we're in a similar boat. It's really struck a chord with us, and we've had a lot of conversations with our employees about what we can do with our hiring, our promotion, our retention, our philanthropy, and our focus. And so we're having those conversations right now. Specifically as regards to M&A, it's too new to say here's how we've thought about it in the context of our process. But what I do know is, as part of our process, we care a lot about the values and shared values of the companies we go at. So understanding, and I realize this is not the same as a target company's specific focus on diversity, but we care a lot about the ethics and the culture of the people we are evaluating to acquire. And I think they're not exactly the same, but they're not that different either. They're linked in that, we don't want to do business with people who are sketchy, for lack of a better word. And unfortunately, sometimes with startups, and maybe it's in ad tech, but I assume everywhere, you come across people who you meet and you just say, boy, that business might be interesting, but not sure we can get over some of the hurdles here.
Mm-hmm. Yes.
And we think that's important. That's really important. Having an ethical core as a company is absolutely critical. And you don't want to do a deal that brings in, people who don't fit, where either, just look at it, ethically and culturally, you're gonna really potentially poison the well. And then financially, you have a much higher probability that this deal's going to go bust. And so you're best to just nip it in the bud.
Yeah. Yeah. One of the questions we had was related to, if we are doing less travel or in-person meetings with M&A deals and teams in the future, does that lead to more mistakes? Like, if M&A continues in volume, do you feel like that leads to more mistakes? I guess naturally you would, if you're not going to spend the time with people. You could let a few companies in that really might not have been the right ones.
I mean, the number one reason why acquisitions fail is cultural and organizational fit.
Mm-hmm.
I think that's been the case for years, and I think the track record actually, at a macro level, is that most acquisitions fail. I'm confident that no one on this call will say that that's the case at their company, but I think that's one of the pieces that makes the in-person engagement and some of the factors that Eric said about screening and ensuring a compatibility and a quality on the team that's for the target that you can verify. That sort of thing only happens when you have a chance to spend time, real time with to get to know the people who are running the entity that you're looking at. So I think it's inevitable that people who sort of ignore the challenges of the current circumstance and sort of press forward with and skip that critical step, I think may wind up feeling like they're not quite sure what they woke up to when this is all over.
Yeah. It's interesting to think about what makes things go downhill on a deal. That's the post-deal culture. Obviously, everybody has an example of that in their past somewhere along the line. What are the things that before the deal closes, what are the gotchas that really could pop up that would derail things? Is that more numbers, like digging into the numbers? And
I think one easy piece of advice to give someone who's selling, I'm sure, Chris, you give this advice all the time, is don't put out a forecast that you're going to miss.
Mm-hmm.
The deal's not going to get done the day after the SEM is published. Time is going to elapse, and the buyer, any credible, sophisticated buyer, is going to be closely looking at how your forecast maps to actual performance.
Yeah.
So I would say that is, if not number one, very high on our list of things that can throw a deal sideways at a later stage. And it's really simple, right? Because if that happens, the buyer's not getting what they thought they were getting.
Yeah. That's a good point. So that front, I've got one more question here that was interesting to me. Apparently Bain came out and recommended that companies should triple down on current customers and focus on current customers. Yet what we've all experienced, at least anecdotally when I talk to people, is that people are more available now than ever because you're captive in front of your computer all day. There's much more screen time, and people are more likely to take calls now. So like, Eric, what's your philosophy? What do you think the philosophy is? What's the best philosophy for a company? Focus, double down on customers, or use this as an opportunity to step on the gas and increase your top of funnel opportunities?
I mean, I guess it depends what stage the company is at. If it's a sort of already an established company, I totally get where Bain is coming from, right? So basically increase same store sales is how I interpret that. If you're really small, you're striving to find product market fit. And the challenge is we've all looked at companies that's like, wow, that's really neat, but they have 4 customers or 7 customers or 27 customers. And it's just, you gotta make some real assumptions to see if it's gonna live in our world. Because our world exists in how do we roll this out broadly, right, across our portfolios. And that's where I run into a little bit of challenge there. But I think, you've got to, if you're selling your company, or sorry, let me be really clear. If you want your company to be bought, because the best deals are the ones where a buyer comes and buys you, as opposed to you sell something. If you want to be bought, I think you have to really understand what the acquiring company is looking for and make sure you have, a fit with that. And at least at our size and scale at Rubicon, we're not looking for little slivers. We're looking for things that, go across large swaths of our of our portfolio. And that's just us and how we happen to run our business. But I think if you're on the sell side here, you want to know that, and you want to figure out how your approach will fit. So one thing you could do, which is advice that was given to me years ago, is, really early in your company's life cycle, you should know all the potential acquirers. You should get to know them. You should see what you can do commercially together, so that it is not a sales process as much as it is just a natural inevitability. We've already worked together. We know each other. Now let's take that final step together. Easy to say, a little bit harder to do in practice, but I think that's, something entrepreneurs should be focusing on.
Sean, were you about to say something? Did you have something to add on that one?
No, but I agree.
A good question on valuation came in. And this kind of pertains to the idea of trying to forecast and do a forecast right in this environment. If you wanted to put a forecast out for the next 6 months, like into Q4, I guess what you're saying, Sean, is it's try and be conservative to the point where you'd be hitting those numbers by the time the deal closed. So there's no misses and surprises at the end. But I got to say, like, it would have to be pretty difficult to, with a whole lot of precision, forecast the back half. When it comes to valuing companies in 2020, let's fast forward to next year. When you look at 2020 revenues and look at their performance from 18, 19 to 2020, if you see a tapering off of growth, like is flat in 2020 over 2019, is that a slap on the back, nice job, equivalent to like 30% growth in this climate? How do you view that?
Interesting. I don't know. I don't know exactly how we're gonna look at 2020, 19 to 20, but there's going to be noise across the board. So I think perhaps a more important indicator will be 19 to 21.
Mm-hmm.
Once you got through the noise of 20,
what's your plan?
Let's look at 19 to 21 as normalized year-over-year growth, and a better approximation of what a normal run rate would look like on this business. But it's really gonna depend by category, by specific business, by size, by customer base.
Yeah. Gil, do you have any thoughts on that?
Well, you're underscoring your optimism, Sean, because it sounds like you're counting on 21 being a normal year, which would be great. Maybe premature. I think it's impossible to lay out a high confidence forecast, I think, at this point for the second half of this year. I actually think sort of trailing 12 months revenue is going to take on, a disproportionately more important role in thinking about valuations than forward revenue projections. And I think entrepreneurs should be thinking about, here are the 2 or 3 things I need to be true in order for this projection to be realized, and to take a conservative view, but show what if things broke positively. Here's what could be accomplished. I just think, like, at the moment, thinking about paying on forward revenue, which has never been realized in that company in a context like this, my guess is going to be challenging for a lot of buyers.
Ryan, what do you think about that?
Yeah, I mean, my 2 cents on the sort of forecasting is we've gone down to the account level and sort of dissected what people are doing there, and then also on a daily level. But that might be because we have, the granularity and forecast down there. And then we've also asked the management teams to give us their viewpoint on a W-shaped, U-shaped, L-shaped square root shaped, whatever shape you
Yeah.
want, recovery. So we could kind of match that to what we're thinking and then overlay those two. But what Gil's saying and how we should be looking at a trailing 12 is spot on as well. And yeah, we know it's going to be challenging for folks, but just to have a more granular budget, I think, or forecast would be really helpful as we're discussing it. So we can help with the sensitivities and the hypothesis of, you know, when this pandemic ends or when we're going to see more of an uptick, so we can layer on our own thinking on top.
Great. Good. I think we're at the top of the hour. I just would like to take a second to thank all you guys, Sean, Eric, Gil, Ryan. Great to see you on the video call today, and just really appreciate your candor and ideas here. And we look forward to having more detailed conversations with you guys in the coming months. And good luck to everybody in terms of navigating through this stuff. And have a nice summer.